All right. What a great intro. Great to be here, folks. I'm Rob Tetrault from robtetrault.com, portfolio manager here at Canaccord Genuity Wealth Management and at the Tetrault Wealth Advisor Group. Thanks for joining us today. Really excited about our guest. Bring him in right away here. But before we do that, no, you know what? I want to bring him right away. We just saw the disclaimer. We'll bring in our guest right away. Today, we have none other than Scott Chan. Scott, let me bring you in here right away. There we go. Scott Chan, MBA, CFA, Managing Director, Equity Research, Financial, specifically stocks, the guy who here at Canaccord Genuity focuses his research, his livelihood on studying the financial companies and a couple others that some wouldn't consider financials perhaps at some other firms. But we are thrilled and lucky to have you here, Scott. Welcome to the show.
Thanks, Rob, for having me. Appreciate it.
I'm going to pull up another chart here. It's the big six Canadian mortgage lending exposure, the percent that is insured versus uninsured. So leading the pack with insured mortgages at 41%, BMO, National 39%, all the way down to Commerce and Royal at 31% and 34%. So this is obviously another risk play that you're commenting on. So 41% of BMO's Canadian mortgages are insured relative to Commerce, only 31%. So I'm guessing this is part of the reason that BMO and CWB are some of your buy targets.
Yeah, it is. BMO's got a high quality mortgage portfolio, but that said, remember their mortgage, they've got the lowest residential mortgage exposure. If you kind of go back to that last picture, so the mortgages that they do or the underwriting they do is more high quality than the rest of the group, going more into the insured bucket. National Bank would be in that range too, because half their book or more than half their book is in that Quebec market. And because mortgages are typically lower, housing prices are lower, they can take a bit more risk because the balances and basically the price volatility in that market is a lot less than what you would see in, say, the GTA or the GVA in the Vancouver market.
Do you think the loan loss provisions will be enough? I know that's a bit of a loaded question, but
no, they're going to have to provision more this quarter.
How much more do you think we're going to add? Like another kind of half of what we had in Q2?
Well, we've got a bit more than that right now. It's really tough to say. We haven't really published anything outside of what we did after the quarter, but I would say it's not going to be as high as what we saw last quarter, Rob, but it's certainly going to still be at the high end.
Let's talk about, maybe we should switch gears and chat briefly. Sorry, anything else you want to add about Canadian banks? We'll go to U.S. banks, and we could talk about, mind you, you've already mentioned BMO and why you like it and CWB. Anything else you want to add on Canadian banks relative? Any of these, anything that I missed here that I should absolutely be chatting about?
Well, I think the biggest question investors ask me is that are there any banks risk of cutting their dividend, right? And I think before last quarter, we were the only analyst to call out that LB should cut their dividend over the next few quarters, and behold, they did. Surprised the market, and LB has underperformed. But the
Laurentian
big six,
Laurentian Bank.
But for the big six banks, like even during that worst time during the pandemic, when we hit those March 23rd lows, the banks are well capitalized. And even in our numbers for fiscal 2021, we've got payout ratios, dividend payout ratios on average at 55%. Even in the last quarter, which is the worst quarter we've seen in decades, the banks still earn to pay their dividends. So
and still earn quite a bit more, quite a bit more
to cover their dividends. So
just for our viewers, real quick, Scott, the dividend payout ratio is the percentage of the dividend is relative to your total profit for that quarter. So if you're paying out 55% of your profits, your dividend payout ratio is 55%. So in this case, the banks were at what was the average yield for the quarter? Must have been 5.5 or 6, somewhere around there.
During the quarter it was over 6, and now it's just under 6%. So CIBC would be at the high end.
You're generating a 10% return on equity there, and paying out 55% of that. So I think your point is, and I'm not trying to make it, I just want to make sure we understood the dividend payout ratio, is there's a lot of spare room, there's a lot of spare capital, there's a lot of spare profits before a bank would cut their dividend, I think is what you're saying.
Yeah, and OSFI, the regulator, has on March 13th, they've told the banks that they can't buy back stock during this pandemic, but they can't raise their dividend, but they can maintain their dividend. Their dividends are very attractive right now. We suspect that OSFI could maybe alter their mind in about a year, and then we would expect the banks, like the big six banks, to resume dividend growth at that time. But it'll probably be at least a year from now.
Okay, this is one of your buys right now. It's BMO. This is a 5-year chart. I'll pull up a 1-year chart here for our viewers, kind of peaking out at about 100, 105 bucks. The stock kind of in January, December fell to as low as, I think it went below 60 bucks. Yeah, 55 bucks on March 23rd, 56 bucks. And it's now hovering around 75 bucks. They did take a lot of impairment provisions. You think it's a healthier debt book with less risk? You think it's a safer play?
Well, I think it's got more upside, the most upside.
More upside. Sorry,
It may not necessarily be the safest play near term, because I said there's the Royal and the National and the TD that are a bit safer, but the Bank of Montreal has got the cheapest multiple up there. So when you see a bank that's trading below book value, specifically a Canadian bank with a prospective ROE in the low double digits, then that's a screaming buy to me on that metric. And even if you look at a price to earnings basis, it ranks cheap. I want to be clear, the sentiment on BMO stock is not great, because every quarter it seems like it has its own hiccup that no one expects, including myself. So last quarter was all the capital market sensitive stuff, in terms of trading losses. The quarter before was like a big restructuring charge. So they've had issues, but if they can kind of control those issues, you'll start to get a good re-rating on that stock, typically where it trades at, and offer a higher total return with a 3-year time period. So it's more of a contrarian pick in this market because it doesn't have a great sentiment, but I think if they can work through those issues, it's got really good upside relative to peers.
Yeah, so it's not a safety play; it's an actual upside play. So
yeah,
thanks for correcting me on that. Let's maybe switch gears and talk about U.S. banks for a bit. Their earnings, the mega banks, the big 6 mega banks, reported last week or so, or 2 weeks ago, and they're all done now. That's in the book. So what are your thoughts on the earnings of the U.S. mega banks?
Yeah, so I don't know if the market really cares about earnings too much short term, Rob. But the earnings are actually very good. So excluding Wells Fargo, they all beat by a handy amount, but a lot of it was driven by capital markets, which is is not as repeatable working at Canaccord, right? Every quarter you're starting from ground zero, but a lot of tailwinds in the quarter in terms of trading, iBanking fees, and advisory, basically. Hand-holding your clients and collecting a fee during this pandemic. So, in terms of the share price performance of the U.S. banks, it generally performed in line with the market during this time period. The other part of the business is a bit more concerning, which is the actual lending business. The NII trends, loan growth declined significantly. Margins compressed a lot more than what the Street was expecting. And remember, this is the first full quarter where the U.S. went into a zero interest rate environment. So, there's several headwinds on its core lending business, and a lot of the market sensitive businesses, including capital markets, wealth, and asset management, really picked up the slack in the quarter. But it's not really repeatable, specifically on the capital market side.
This is a short-term chart here, 1 month chart of the IYF ETF, which is the iShares Dow Jones U.S. Financial Index. It shows a bit of a bump here after the last earnings were announced kind of a week or two ago. Now hovering still well below where we were in February here, about 25% below where we were roughly in February. So I remember the first earnings came out. I don't know if it was Morgan Stanley. I forget which ones came out, and it was like a home run on capital markets. So the concern is obviously you can't repeat capital markets every quarter. You're not going to get IPOs every single quarter. You're not going to get new issues and secondary offerings. And so I guess that's a concern. But aside from that specific piece, it still wasn't as bad as the analyst has expected, right? Or am I wrong on that?
Yeah, no, it wasn't as bad for sure. So, the capital markets was a lot better than people suspected. So that kind of provided some of the variation to what the Street was expecting. The core lending stuff really came off a little bit. So we talked about some certain sectors that were working before, commercial, business, credit cards. They're all down high single digits sequentially. And remember, the U.S. market is a bit different than the Canadian market. It was shut down for the full quarter, right? Because it's got a different fiscal quarter, and the pandemic seems to be a bit worse there. So if you look at credit, and then going back to our conversation on credit, in general, Rob, the U.S. banks reserved more this quarter than last quarter because the pandemic in the U.S. they're just a bit more worried, so they're reserving a bit more allowances on that front. And that's why I say when I look at the Canadian banks and what we have right now, and with their exposure on the U.S. side, we could see a bit of an uplift on reserves because of what we've seen on the U.S. side.
Do you mean the fact that they're getting 60 to 70,000 new cases every single day in the U.S.?
Yeah, it's alarming. I mean, following it state by state and by regional bank, it's
definitely not funny. I was making light of your point. So do you think you're going to start to see a kind of divergence of loan loss provisions US banks versus Canadian banks because of that?
A bit of a divergence. You're starting to see it in this quarter for sure. Last quarter was very similar, right? Because they're just taking their best shot at the start, right, during this pandemic, and it just shot up. But I think it's safe to say when you look at the next few quarters, I think when you look at the US market, it could peak in certain banks like JP Morgan, who's been very conservative, but I think it's very mixed. I don't know if you've seen the high watermark on the US side. And in Canada, I think you have, just based on kind of cases of what you talked about in Manitoba and the improvements that we've been seeing in other parts of the country as well. So I think you'll see that divergence as you talked about, but this quarter would be the widest divergence.
And there's your JP Morgan. It was kind of at 137, 138 right before COVID, dipped below 80, and now it's back up to about $100. Are there any specific names in the US that you really like, or any other regional banks that you really like, or that we got to buy? Canaccord has a buy on right now.
I mean, I don't cover the US banks, but just big picture, looking at the past earnings, like JP Morgan was another high quality beat, gaining market share. That would be the one that people gravitate to. And Wells Fargo could be a contrarian play just based on I think they're down 55% and they've cut their dividends. So all the bad news is disseminated in the stock. And I think if you look at going forward, and that's what the market does, you could see a bit of optimism in the business model going forward.
Sorry, anything else on the US side that's interesting that you'd like to add, Scott?
I think one final point just on capital, because capital is so important. And the one thing to note with the U.S. banks, Rob, is that the capital in terms of, the CET1 ratio that the regulators go by was actually up quarter over quarter. So kind of goes back to that dividend payment stuff and being able to pay your dividends. It seems like there's no risk of further dividend cuts outside of Wells Fargo for the U.S. banks right now because of the strong capital position, which is better quarter for quarter, which is a good sign.
Yeah, my dad used to always say, take it to the bank that they're never going to cut the distributions. Like a Canadian bank will never cut their distribution. So I didn't even ask you that question, but I don't think we could say the same about the US banks because 08, you recall that story in 08, how some got really, really beat up bad and some almost didn't survive. And so the dividend cut here by Wells Fargo, I don't think was unexpected for sure, given what they're going through down there. Hey, what about international exposure? I know you talked a bit about it a little bit, but can you touch on international exposure for the Canadian banks and what that might mean, one, for the risk and two, for the upside? I know you touched a bit for emerging markets, but.
Yeah, so for the Canadian banks, TD would have the most US exposure. So it's about 35% of the book. This is core retail lending. So if I kind of look at Bank of America, their consumer banking retail was very disappointing. So we think there's higher risk of TD heading into the quarter. One, they're levered to more slower loan growth on the retail side and on the credit side. They've got more exposure to that shorter end of the rate curve, which we've seen go down to zero. And then in terms of credit, with credit cards and their higher exposure, we could see higher credit there. And TD's retail segment has just been on the downward trend, but I think this quarter you could see that continue in a material way. BMO is a bit opposite. They're 30% exposure. They're more into commercial, higher exposure into commercial. And commercial is at risk too, Rob, because if I look at the U.S. banks, you had about 8% sequential decline.
Hey, I may have lost Scott again. He was talking about the decline. Scott, you there again? You back?
Yeah, I'm here. Yeah.
Yeah, sorry, cut out there for a bit. So you either could pick that point up again if you'd like, or I was going to ask you about loan growth.
Yeah, I think I was talking about TD. They had the highest exposure, 35%. Retail, a lot of it's the personal side, like Bank of America. Bank of America disappointed in the quarter in that regard. So slower loan growth, as you kind of just talked about. And it's just a lot of NIM compression. And then in TD's case, they've got the highest exposure to the short end of the curve. So when rates dropped, like we've seen US go to zero, they're highly susceptible to have further margin contraction. And then when going back to our credit card talk, TD's got the biggest exposure in the US as well. And credit cards are more risky. And you saw banks like Bank of America set up more allowances in the quarter. So, look at the bottom line at TD's U.S. retail, we could see risk over the coming quarters, including the next quarter.
We were going to chat on loan growth real quick, but I mean, you talked about it already. Anything you want to add there on the growth of the loans for the banks?
The one weird bright spot on loan growth during this pandemic is residential mortgages, right? And you saw that in the U.S. and you're seeing that in Canada. And typically when you have a recession or a real recession, housing prices aren't up and residential mortgage growth, is not up like we've seen lately. So that's very interesting to point out on the loan growth side. But every other category, when you look at it, has been down meaningfully over the last 3-4 months. So we're talking about credit cards, commercial businesses, home equity lines. auto, residential mortgage has been a bright spot, and it's the largest exposure too in each book. So it's actually helping protect the overall size of the book in these banks.
Auto just about stopped there, for a month or two.
Yeah,
It's
stopped
pretty
completely.
much stopped. I have a few friends that are in the industry, and yeah, it's tough times.